What's going on, everybody, and welcome on into the video. So today we got a lot to talk about when it comes to day trading and when it comes to T+1. Now, you may be more familiar with T+2. We're going to talk about the potential T+1 rule, what that actually means, and how that relates to you and your own trading when it comes to day trading and when it comes to settling your trades much faster than before. Feels like I've been doing a lot of streams lately, so getting back in the groove of making a video, but I wanted to make this video so that someone can come across that in the future, or, it's helpful to share and whatnot. It's not the full length of a stream, right? But there's a couple things we gotta cover first. So first off, let's talk about day trading, okay? If you're using a margin account and your account is under $25,000, you are restricted to 3 day trades per 5 trading days. Let's say this next week, the market's open Monday, Tuesday, Wednesday, Thursday, Friday. And you day trade Tesla on Monday, you do it again on Tuesday, and then you do it again on Wednesday. Now, a day trade means you're buying shares and selling some of those shares or all of those shares on the same day. If you were to buy 10 shares of Tesla and you sold 1 at 1 p.m. and then you sold 9 more at 2 p.m., that would still count as 1 day trade. However, if you were to go buy after that first sell, then you buy back and sell again, that would be then 2 day trades. So let's say I bought 5 shares of Tesla at noon. And then I was to sell those 5 shares at 2 p.m. And then I was to then buy back 5 shares at 2:30 and then sell again at 3. That would be then 2 day trades, okay? So when it comes down to it, you only get 5 of those per 5 trading days. So you're like, oh, I want to split this up. I want to make sure I can have the ability to do this. So one way to get around this is open up multiple brokerage accounts, okay? So I can open up an account with TD Ameritrade. I can have a Fidelity. I can have a Webull, a Moomoo. I can have this, Robinhood, that. Doesn't matter. I can open a bunch and I'm going to get 3 day trades per 5 days on each of those accounts, which is great. And that's one way that many people split their money up on margin accounts. However, there's a better way to do it, at least in my opinion. And we'll talk about what this is, and then we'll dive into what T+1 means and the potential of this and the SEC's proposal. You ever heard of a cash account? It's something that a lot of people kind of overlook, but a cash account allows you to day trade as much as you want with a restriction. You can only day trade using settled cash, or you run the risk of a good faith violation, which that's a whole other rabbit hole. And at the end of the day, you don't want to keep having good faith violations. You have 1 or 2, you might be okay with it. The broker might allow you, but after that, they'll probably ban you or they'll restrict you and you'll have more issues. So you don't want that to happen, right? At the end of the day. But on a cash account, if let's say I had $1,000 in my cash account, and I take that $1,000 and I go buy 1 share of Tesla. Let's say Tesla's at exactly $1,000, and I buy 1 share of Tesla, and then I was to sell that the next day or even today, the same day. I can day trade as much as I want. Let's say I only use $100 and I do that 10 times. I can do that as much as I want. The problem is that money is going to take a couple days to settle. And as of now with T+2, if you buy and sell on Monday, let's say you buy 1 share of Tesla on Monday for $1,000, you sell it for $1,010, it goes up $10, you make $10, great, you make $10, awesome. And you sell it the same day. Well, T+2 means it's not gonna settle, that cash, that $1,010 is not gonna settle in your account until Wednesday. So you can't even use it until Wednesday. So that's a problem, or that stinks. However, if you're using a cash account and you want a day trade, well, you can just limit your sizing. So for example, I could take $100 and I can go buy fractional shares of Tesla, or I can buy Tesla options, or I can buy, a penny stock, or I can buy whatever stock I want to buy. And I buy with that $100, I buy some shares. Let's say the same day I want to sell those shares, get out of my position, it's either a loss or it's a winner, I sell it. I've only used up $100. That $100 on Monday will then settle by Wednesday. So now, Monday afternoon, I got $900 of settled cash. Let's say on Tuesday, I go and do the same exact thing with $100. I go make a day trade. Let's say I go make 3 day trades on Tuesday. That means I'm now using up $300 of settled cash. If I'm using a $100 size per day trade, I'm using up $300 of settled cash on Tuesday. I already used $100 on Monday. Now it's technically 4 day trades. Am I going to get screwed by the pattern day trade rule? No, because I'm on a cash account. That rule does not apply to a cash account. But I've now used $400 of settled cash. Okay, cool. Now that Wednesday comes along, I now have that $100 that I used on Monday. That becomes now settled cash. But the $300 that I used on Tuesday, that takes now till Thursday for that to settle based on the T+2 settlement structure. So now Wednesday comes along and there's some crazy opportunity and I want to buy Tesla stock, but guess what? I only have $700 available of settled cash and Tesla's trading for $1,000. I can't buy a share of Tesla. because I don't have enough settled cash to buy that. Now, if I was to go ahead and do it, I have to now wait until that money settles on Thursday for me to be able to sell that. So that will be a good faith violation if I was to use unsettled cash to buy something and then sell it the same day or before the cash that I had previously looking to settle settles. Okay, kind of complicated, kind of confusing, but hopefully that makes some sense. When you're using a cash account, you have to make sure you have the settled cash to go ahead and buy the shares and then go ahead and take advantage. Now, on a cash account, you probably can't short. Now, you can play options and short, but you probably can't short stocks, which is the benefit of having a margin account. So there's a lot of kind of ups and downs. There's a lot of pros and cons to having a cash versus a margin. And some people like having the margin because they'll split their portfolios up into three different accounts, 3 different brokers, and then they'll have 3-day trades per 5 days here, 3 here, and 3 here, and then they have 9, or they have 12, or they have 15, depending on how many accounts they have open, if they want to use it. Others like to have all one account. Just minimize your size, don't be using your entire portfolio per trade, and you shouldn't have a problem. Well, now things are going to get a lot better because take a look at this. The SEC proposes shortening the settlement cycle to T+1 and talks about T+0. Talk about same-day settlement potentially going forward. Now, when we're filming this video, it's only come out in the coming weeks, so we're kind of in the early stages. It's not official yet, it hasn't happened, but the great thing about this is that over time, with technology, we've been able to settle trades faster. And there's actually some reasons why they're looking to do this. If we look and ask the question, why should we shorten the settlement cycle? Well, here are some of the answers. It's designed to reduce the credit market and liquidity risks, insecurities, and transactions faced by the market participants and US investors. Not to mention, we saw some crazy volatility with the meme stocks last year, AMC, GameStop, SNL, all those stocks that got halted because what happened? That crazy volatility actually forced the clearinghouses to essentially, that those places are the ones that guarantee the trades and they guarantee that all kind of connects and all works out. They forced essentially these brokerage platforms to pay billions of dollars in collateral so that they can guarantee the trades in case a party defaults or whatnot. And so in that sense, many platforms had to restrict trading or a lot of stocks because they couldn't pay that. They couldn't physically handle that. And so by shortening up the settlement time, this could help alleviate some of these concerns in the future, and that's why the SEC is now getting involved and looking to make this move. So if you want to go back years ago, we actually had T+5 business days to settle transactions, and that eventually got bumped to T+3. Today it's T+2, and realistically now it could be T+1 in the relatively near term. So again, let's run through a quick example. If you had Microsoft and you bought Microsoft on Friday, technically speaking, this wouldn't actually register until Tuesday, right? Wait, Monday, Tuesday. Now, if you bought and sold, right, on Microsoft on Friday, technically speaking, that now you have you have no position in Microsoft going into the weekend. However, that settled cash from the transaction won't actually hit your account, won't settle in your account until that Tuesday. That's what essentially it means. So now in the T+1 scenario, let's say I had a $1,000 portfolio, right? And I'm sitting there with $1,000 and I'm like, all right, awesome. I'm going to go ahead, I'm going to go buy $500 worth of Microsoft stock and I'm going to day trade it. And I buy $500 worth and then I sell and I get 510 back and I make a few bucks. I make 10 bucks. Awesome, cool, great. In the T+1 scenario, I'm now going to have that money settled, not today. So I'm not going to be able to make a day trade right after that. That $500 is still technically unsettled right after I sell it, but tomorrow it's going to settle and I can have that money available to then trade again and make another day trade tomorrow. So that's a massive, massive benefit for those using a cash account. And realistically, if you're using proper sizing where you're not going in massive your entire portfolio into any position, this should alleviate a lot of the issues we've had with worrying about settled cash and the downsides of a cash account. Obviously, there's other downsides in terms of shorting and whatnot, but in no use of margin, right? But now, if you can day trade, pretty much have that money settle the next day, you're in a really good spot in terms of having that, always having money available, always being able to trade and not having the restrictions that you may have had with the T+2 settlement time frame that we've been dealing with for quite some time now. Now, real quick in terms of timeline. So if this is adopted, okay, this will be going into place as of now by March 31st, 2024. So still quite some time in the future from when we're making this video, but nonetheless, it's still an important change that could be coming in the near future and that could really benefit a lot of cash account traders. Let me know your thoughts in the comment section down below, and if you would love to take advantage of this and if you learned something from the video, all we ask is a thumbs up. Consider subscribing for more videos, more streams. Thanks so much for watching, guys. We'll leave links and resources down below. Get some free stocks, Weeble, Moo. Check out our technical analysis course if you're ever interested, and we'll see you guys in the next one. Peace.